Hello, good morning. You're watching the markets on 80 now. I'm Anisha Jain. With me is Nikunj Dalmia as well as Rajesh Sharma, and we're starting a fresh news series. Yes, it's not starting on the most of the positive note, given the fact yesterday was a bit weak for the market. In fact, we saw quite a bit of topple, but by the end of the trading session, we managed to recoup some of the losses. Just 19,500 is what we managed to kind of hold on to. We are back to the September start lows that we had started the month with. Even if you look yesterday, all the sectors ended in the red, and it's heavyweight that continues to drag the markets, whether it's Reliance, Infosys, which was coming under a lot of pressure yesterday, or ITC as well for that matter. All of these stocks are something which has been dragging their feet, and that's the reason we are sitting at crucial level now, 19,500 at the index level, Nikunj.
Yeah, that's what markets are. And frankly, the market, again, you talk about the market in terms of the index positioning and also the positioning of the tone and the tonality of the market. Look, now the heavyweights are dragging the market. The reason why heavyweights are dragging the market is because globally there is a bit of a reversal. Flows now for the month, they are deep in the negative. And given the construct of where the macro is moving, whether it is crude, whether it is bond yields, the market in a sense have now caved below that range. And if Nifty caves has come below the range, what are we likely to expect? We could see more unwinding and more pressure in mid and small cap stocks, and the market now would look for leadership. So I think the next couple of days would be hard to call, but the trigger for the market should be in and around earnings season, should be in and around when you start getting sense about the festival season. I don't expect the market correction to be very deep. It would be a shallow correction for benchmark indices looking at the valuation and the construct of the economy. But in the mid and small cap stocks, I think there would be a lot more volatility rather than a linear move, what we've seen in, let's say, August or September.
Nikunj, in fact, market was expecting some amount of support from the IT stocks, and IT did between last series, 1.5 series, did rally. But by the looks of it, last evening, the Accenture guidance and commentary, do you think that support also could be pulled off from the market?
JJ, my sense was that IT was never a driver. IT was always something which in a sense became like a safety ledge, and this market rotated back into IT. Now what is slightly disheartening is that Accenture guidance is coming, and this comments from the CEO pointing to the fact that they still expect a weak exit and they are not very confident about the economic conditions. But what we heard from the Fed last week in terms of the US economic outlook, there is a vast difference in what the real economy in US is doing versus what is happening to the IT sector per se. Indian IT companies have always benefited because of the growth in US IT. So large part of the slowdown actually started largely because of what happened to Europe and what happened to US. But even the US economy has come back. Europe has stabilized. That has not really translated into some kind of a momentum for Accenture. Now, Accenture, we all know, is a lead indicator, but not the perfect indicator. So the lead indicator for IT is not looking great. Not that IT is like a line position, is not like the biggest overweight positioning in the market, but minus IT, minus Reliance, minus ITC, minus HDFC Bank, what will really take the markets higher? So that I think is a big question mark. And by the way, last couple of days, some brokerages did come out with some Braveheart reports. I mean, I would call them Braveheart reports, because if you're coming out with a report on IT, you indeed need a Braveheart, and those Braveheart reports now have to be assessed realistically.
Oh, well, yes, and again, today tables have turned. There are downgrades which have come in again on IT today, so it's a very flip-flop situation. But I think the worst part was, of course, not only the weak guidance, but the bookings coming down by 10% year on year, because for the rest of the IT pack, at least we have seen that the deal flow has been quite strong. But for Accenture, that was the weak link. And talking about, of course, its base market, US, etc., there at least the GDP data has come in pretty much in line with expectation. That came in at 2.1% versus 2.2% expectation, and that's the reason yesterday we saw a decent amount of action when it comes to the US market. Dow was up a good 100 points. The S&P as well as Nasdaq managed to eke out some gains after many weeks of that consolidation that we had seen in the US markets as well. But back home, apart from IT, auto stocks are also going to be in focus because come tomorrow we'll get all those data as far as the September auto sales is concerned. But there at least we're expecting good news because the festive cheer is something that should start setting in. We heard from a lot of companies right from the fact when Maruti came on the channel and they said that growth in Onam was better than expected. Across the board, we have almost seen 20% growth when it comes to Onam Day as well. The two-wheeler festive season has also started on a decent note. For CVs as well, there's an improvement in freight demand. So all the factors are looking good, Nikunj, right now in terms of the auto sales. But of course, it's also about valuations and also about the sustainability of this number.
See, let's understand what we will get in next 2 days. When we say we will get auto dispatch numbers, these are wholesale numbers. Right. These are numbers which would be dispatched by the company. Now, these are not the sale numbers. These are not the retail numbers. Now, Maruti and other managements, what they've indicated to us is that they're reasonably confident that this time the festival season will be good. So right now, inventory levels, I think, are getting, so they are in a sense increasing the inventory levels. So this is the first indication that the management is confident that demand will come back, but it's only after the festival season, after Ganpati, Diwali, Dussehra, we will know that the real demand has made a comeback or not. Within that, I think for me, for next couple of months, the dark horse is not Mahindra and Mahindra, but it is Maruti. Mahindra and Mahindra was the dark horse of 2022 when they had new launches, when XUV 500 hit out of the park, Thar, occupied center stage, and this entire move from sedan to SUV is something which really surprised us. Now, Maruti has two things. One, can their SUV business surprise us in terms of market share gain and customer recall, and B, the pressure what everybody is expecting in the sedan market, will that be minimal? So in terms of a move where you could expect both impact of news flow and also impact of what market positioning is, I think right up there is Maruti. Eicher is something which markets are well aware of, that the Halil Honda launch has not impacted them. Bajaj, it's a play on exports, frankly no relation whatsoever with what is happening to the domestic market, at least in the short term. And then trucks, I don't think CV is something you can connect it with festival season so much so. But in general, I think the trend there has been strong. So if you have to pull the real big one from the entire auto basket, I think it's going to be Maruti, where the news in a sense will be stock moving.
Nikunj, did you manage to catch some of the global cues which came in? The Q2 GDP came in line with estimates. Now they're talking about PCE data, the core consumption data, which Fed watches very closely, will be out today. So we'll react on it Monday morning. But there was mild softness in yields, but not a whole lot has changed in the last 2-3 days.
Sajay, what are markets telling you? Markets are telling you that, look, interest rates will remain high. And the assumption at the beginning of the year, which was that rates will peak out and they will start declining in the second half of the year as US perhaps could head towards a mild recession or a soft landing, that entire paradigm has changed. Now the new paradigm is that rates will move higher. Rates should stay higher. And we are looking at a very different kind of a setup for 2023 second half and beyond that. Now that changes the outlook. That changes the outlook for flows. That changes the outlook in the way how the near-term markets would move. Now we can, we can chop and church and slice and dice the US economic data in terms of the payroll data once in a while, or what is going to happen to the GDP data, or which way inflation is moving. Bottom line here is that Fed has reset the template and clearly indicated that higher rates are here. They may not move, but they are surely not done with the rate hiking cycle. Then the joker, I think, is still China, where what kind of data we are getting. So the world is not, so where the surprise has come in from, one US, where the fall and decline has not been great, and second China, where the recovery has just disappointed.
In fact, the US market is all set to post worse returns, monthly returns this year. Almost 4 to 6% got from the three indices in September alone, which is the worst performance this year till date. But how are things likely to pan out from here on flows front? Yes, macros are a bit concerning, but how are positioning by the funds actually happening? Cameron Brand at EPFR is joining us for more on that. Cameron, morning. Thank you very much for your time. Now we all know the bad news. Crude is rallying hard. Yields and dollar index also at multi-year highs. But how are the practitioners of money management actually positioning? Are the hedges being bought? Are the flows coming out of emerging markets going towards safer havens?
Emerging market funds in general have held up very well this year. That said, there continues to be a strong bias towards direct exposure to the major Asian markets, of which India is one. But flows into dedicated China funds have held up surprisingly well, though that is increasingly due to domestic rather than foreign support. The diversified global emerging markets funds are starting to see some pressure and some significant outflows. And since they have an 8-9% allocation on average to India, that's going to take a bite out of your market.
Sure. So you're saying that the China flows are still holding up pretty much okay, but for India itself, are the flows incrementally increasing? And within US as well, is there a big shift happening outside with the money moving out of tech into bonds or safer havens?
It's a little less direct than that. I'll start with India. Dedicated India equity funds are closing in on their record inflow streak that was set back in 2003, 2004. And those flows, which are definitely above average, seem to be very resilient. They keep coming week in, week out, much higher than we've been used to seeing in recent years. In terms of your question of a rotation in the US from tech to bonds, at the moment there seems to be enough demand for both. Information technology funds have constantly defied the steady tightening that has been going on in the background. And in the meantime, a tremendous amount of pent-up demand from individual investors and institutions like pension funds for sovereign debt that actually yields something. So even though issuance has been very high over a year, and the Fed is running off some of its balance sheet, certainly from a fund flow perspective, this was actually the first week this year that U.S. bond funds saw outflows.
Okay, Cameron, the new talk, the new opinion with most of the money managers is that you're getting 5% assured safe return in US bond market. And that is a very impressive return given the construct of the valuation and the market volatility. Do you think a 5% yield is a good enough yield, and this in a sense could have impact on emerging market flows in general?
I think it could if it holds on long enough. What we've seen here is that the source of funds that the big money market funds here have started to suck in as they've been able to offer yields up towards that level is the money that was sitting in commercial and retail bank products. People are not so far showing much signs of sort of cashing out other investments and steering the money into money market funds. But that could change. People are certainly noticing that cash yields at the moment are very attractive. And it's looking like a near record year in terms of inflows for U.S. liquidity funds.
Interesting. Thank you, Cameron, for making time and speaking with us. Appreciate you joining us on ET Now. But let's get
You're welcome.
Let's get more specific about our own markets and discuss how the October series is likely to pan out, because if you go by historical trends, the month of October has been actually quite nice for the Indian markets and bulls specifically, because 9 out of 10 times they have managed to return positive returns for the month of October. Nooresh, Merani as well as Kunal Bothra is always with us. Kunal, you go first. Yesterday, of course, was a sharp slip that we saw in the market, slip below 19,500. From here on, do you expect a bit of a reversal, or there's a possibility that we might stare at 19,300 as well, because that's what even Lawrence Blanco was talking about?
Yeah, good morning, Nisha. So 19,300 is something which we expected a few days back when the markets were showing signs of weakness. This was actually a retest of the previous lows. So, index, they tend to replicate what happens to the larger cap names. Many of the large cap stocks, they've already shown signs of weakness, come back to their July and August, start lows for themselves. Some of them have managed to breach below those levels. Some of them have just consolidated at the previous support points, which means that the indices should try and come back closer to that 90,300 levels. Now, the concern for the market is that the weakness which happens on an intraday basis, so it opens on a slight gap up node, and then on intraday basis it gets into a selling pressure. So that could make taking a trade at the start a lot more trickier. So you have to wait out for a point where the index comes back to a resistance, and then look out for initiating a fresh short.
Nooresh is also here with us. Nooresh, morning. Beyond Nifty, Bank Nifty as well, if you see the small cap, mid cap index yesterday saw early signs of, some signs of capitulation, did not take support even at the 20 DMA. What are your thoughts on especially the intraday move? There was not single attempt of any pullback. It was just a one-way slide yesterday.
So there is one observation which has been there on the markets. Every last day of the month generally sees a lot of rejig. So we saw that we made a bottom last month on 31st August exactly, and we started reversing from that. That is the point where we were at 19,200, 250. And now we saw yesterday a big FII sell figure. We saw a lot of rejigs happen. So what we look out for is what happens over the next two sessions. A lot of that action happens in the last 30 minutes, 1 hour. And we saw for the whole day, the Nifty was drifting lower. The small caps were holding on, but they did see a little bit of a dip by end of the day. So overall, the view is 19,500 is a support. And from this point of time, there could be a possibility of a short-term reversal. Same is the case with the Bank Nifty. As well as the mid-cap, small-cap indices did not break the previous day lows, neither did Bank Nifty. So we watch out today. If we do not break 19,500 on a closing basis, that's actually a signal for a reversal from here and a bounce back towards 19,800 also.
Okay, preparing for a bounce back. If we don't go below 19,500, that's the word coming in from Nooresh. But let's get stock specific. Kunal, your ideas?
So I'll go with two buy calls. First one is one Ipca Labs. That stock forming a bullish flag pattern, and interestingly, it's showing signs of very strong relative outperformance. So would suggest a buy 975 as a target, stop loss at 900, and going for a contra buy on Gujarat Gas. That stock is extremely oversold in terms of the indicators, trading at 414 odd mark, and would suggest a buy with a target of 430, stop loss at 405.
Interesting. Nooresh, what are your trading ideas this morning?
So two large cap names. First is a buy on ONGC. The stock is very close to a new 52-week high and an all-time high. Also, the fact that crude prices have gone up. Most of the energy stocks across the world have hit new all-time highs. Some have crossed 2007 highs. Same way for ONGC, the stock was at 185, 190 when crude topped at 130 odd levels. And now we are back to those levels after almost a year and a half too. So setting up for a big breakout here, could expect a target price of 220 plus, stop loss to be kept at 184. Second is the buy on Axis Bank, which has been a relative outperformer in the last few weeks, where Bank Nifty has corrected. Banks have been sideways. The stock continues to be closer to new 52-week and high and all-time highs, and sustaining about the last breakout of 1,000. Expecting this to move towards 1,100, 1,150 in the short term. Stop loss to be kept at 980.
Those are the top recommendations coming in from our chartists. But what are the stocks that are going to be in news? We have Somit joining us in the studio to talk to us about that. Interesting one coming in for MCX. One day up, and today perhaps it's going to be one day down. A lot of flip-flop.
And it's a FNO stock, by the way. So people who carried position yesterday, what will happen to them?
Well, obviously,
Which shared in the morning, right?
Yeah, given the fact it was a surprise move actually coming in from SEBI. It was not at all expected by anyone in the street, not the analyst community, not the company itself, that SEBI will go ahead and put this on hold. Now, what does this do? It increases the cost for the company by around 125 crore per quarter. That's the additional cost that they will have to bear. And remember one thing, yesterday the stock went up 8% purely on the back of the announcement that they had said that the new software will be launched on 3rd of October. And for this month itself, if you see, we have been continuously reporting the news that have been coming around for the software launch. The stock has been up 24%. And the one and only reason behind this up move in MCX was the launch of new software. And as per multiple analysts, the launch of new software was the re-rating event for the company. Now, given the fact that SEBI has put this on hold, and when this software will be launched, again, thus the overhang period will start for MCX. So we could see a bit of pressure, right?
See, stocks seen a run up from 1500 to 2000, only in anticipation and expectation that this would, the entire so-called software platform implementation would go through. But it's a regulator who's put this entire implementation in some kind of an abeyance, and they've not put out any kind of an criteria that you meet these criterias, and once you meet these criterias, you essentially would be able, you will get the permission. Now, regulator, if they are coming out and putting something in abeyance when the launch was just round the corner, it clearly means that they are not satisfied with, let's say, the efficiency of the platform. See, what is the regulator looking? The regulator essentially has to ensure that in this entire process of shift of the software, the entire platform and the entire ecosystem, in a sense, is easy enough, and it just does not change. It is easy enough for in terms of implementation, but the regulator does not think like that. Now, we don't know how soon the permission would come. We don't know what the criteria is. But typically when the regulator puts anything in any kind of an abeyance, it's going to take some time before they get a permission, because then there would be back and forth, some mock drills, some testing. And I think this has got to do with the software, where the regulator in this sense is not convinced with whatever implementation or whatever the route of implementation is. It's technical in nature. I mean, my understanding on that is not that high, but all I can say is that when a regulator comes out with something like this, it'll have an impact in terms of the event uncertainty. A 500 rupee move because of this, now it moves into abeyance. Can the entire gain be wiped out? The answer to that is yes.
Yeah, it is pretty risky to trade just purely on this news.
No, but
there
it's
was
rare.
nothing in visibility that will be stopped.
Yes.
Like, there was
In fact,
no
what we were,
expectation at all.
Our chat with the trader community also suggested that nothing was wrong in the software and everything was going on smooth.
My
Even
point is, why did the
convers-
regulator not come up early? And why is that they
Overnight
officially...
only,
So in a sense, they did not get all the green light. And if they did not get the green light, then why did MCX actually officially announce that they're going ahead with it? I mean, it is like saying that when you're telling your family that, look, I'm coming for a family visit, you have to book the train ticket.
You've not booked the train ticket
Exactly.
and already announced that.
Exactly.
And TCS, who's been doing this, they also have been kind of working round the clock to make it happen. It's a bit of a blot on their face as well. That
Because their reputation also
Exactly.
gets impacted.
And I think TCS in a sense was, also indicating that, look, finally
we are
ready.
on course
yeah, we
to-
have cleared all the bugs. Hopefully, we should be okay with it. But let's see what happens, because for now we don't have much details as to why it has been put in abeyance.
So we'll wait for that to come out.
It'll be very interesting.
But the other stock in focus is Chola, big QIP, and the way others also getting, and Chola, of course, a premium name there, would get good response.
Well, yes, that's what we're understanding, given the fact that also the pricing at which they are coming out with this QIP is not much at a discount compared to the last 5-day average price. If you see, they have given a floor price of 1200 rupees, which is largely at par with the current market price also. So 2000 crore is what they're looking to raise via equity, and 2000 crore will be raised via compulsory convertible debentures, which will have an annual coupon rate of 7.5% and will be converted post September 2026. So what does this do now? It increases the CET1 ratio by around 200 basis points, and because of this, what analysts believe that the company will have sufficient fund for growth over the next 2 to 3 years. Now, this is the most important part, because if you see, Chola has been growing its AUM at around 40% and it needed this capital to support this growth going forward, and analysts believe that this fundraise will support that growth for the next 2 to 3 years. Now, ROEs is one thing that could be diluted a bit from around 20% what they did in the last quarter. It could come down to around 18.5%. But again, book value accretion is something that's going to happen at around 13%. That's what the analyst community is suggesting. But we have been seeing a lot of NBFCs raising fund. Bajaj Finance came out with this announcement. Then now this Chola, which is looking to raise close to 4,000 crore.
Manappuram as well next
Nikunj, this is being called as growth capital to fund that 40% kind of growth. They are in a sweet spot in Navy.
See, Chola is a conservative management, and they pretty much know how to balance their growth. They will not grow their book in an exponential manner. They're very mindful of the risk, but when they see visibility, they are always ready to change gears. And I said the same thing for Bajaj Capital, that look, they are growing fantastically well, but when they've come out with this kind of an capital raise, that typically means that in the near term, they're ready to change their gears. You know, from the 4th gear in Mumbai Road, if you go to the 6th gear, which is permissible as per the car you have, I think that just tells you that you're looking at a different growth trajectory. That I think applies for Chola, that they're looking at a different kind of a growth trajectory. The problem with something like Chola and Bajaj Finance is that everybody loves it, everybody owns it. So now the incremental move because of this fundraise, like say what we saw in Bajaj Finance, was like a one-day effect. market reacted one day and then the stock has settled. I think the similar factor could be at play for Chola, where the market reaction could be today, tomorrow, but it may, the stock movement, once this news reaction is over, will be a function of earnings rather than perception change. There are a lot of stocks go through both earnings change and perception change. But I think in case of Chola and Bajaj Finance, I think the perception change has happened. But the changing gears, that just tells you that they are in a comfort zone in terms of the near-term visibility. Look, if smaller NBFCs and PSU banks, if they raise this kind of an capital, then you get worried. That boss, where will they grow and how will they lend? The checks and balances are not fantastic. But Chola and Bajaj, they understand how to lend. See, in India, lending is very easy, but borrowing is very difficult.
Elections.
So the thing with Chola, no, not elections, the whole mechanism. With Chola and with Bajaj Finance, lending is very easy. But recovery, I think, is where it really matters in terms of efficiency. पैसा देना तो बहुत easy है.
But वापस
लेना है तो difficult.
That's the part. All right, we'll take a short break on that note, come back, discuss many more ideas. But meanwhile, also hear out Vikas Khemani. What are the stocks on his radar?
See, if India economic growth story has to happen, if India investment cycle has to happen, L&T is the flag bearer of that. You can't build India without L&T benefiting. India L&T is present across all segments, whether it is hydrocarbons to infrastructure to industrials to everything, residential, everything. It's kind of broadly defense. Everywhere it is kind of positioned well, and all these cylinders are firing. And more important, in last 5-7 years, management has worked hard in terms of getting their capital allocation right, focusing on ROC, and also they have created fabulous business in terms of IT services. So the company has got transformed, over last decade or so, and in the recent past, focus on capital allocation. So, and more importantly, I think the investment cycle in India and in Middle East, where L&T is very strong, is picking up in a big way. So it will remain beneficiary, according to us, in the foreseeable future. At least I see for next 3 to 5 years, nothing changing, negatively for the sector and company in specific. So our again idea is to remain invested into structural ideas.
Welcome back. Well, a lot of factors to watch out today, but one space which is going to be in a lot of action is IT as well. So let's take the technical call from Kunal as well as to where one should position yourself and how you should position yourself in the IT space. Kunal, what's the recommendation?
So I think in terms of the IT stocks, I would still stick to larger cap names as of now. So maybe the likes of Infosys, TCS, it could probably be better.
Kunal, just hold that thought. We'll come back to you. But Nooresh, let me first come to you. What's your take on IT and any favorites?
So in terms of IT, the favorites are to be with the large cap names, something like a TCS, which closer to 3400, 3450 is a buy. In the current dip, HCL Tech would be a buy, closer to 1200 levels. So these are the two names which I like. The mid cap and the small cap IT names are actually showing some signs of topping out. And with the results coming in the next 2 weeks, the risk is any negative result reaction would be a 6 to 10% drop in a lot of them. So the risk reward is not great in a lot of names. Something like Persistent, which was outperformed, is showing signs of topping out. So I would stick with TCS and HCL Tech in the IT pack.
Okay, so we'll come back and take the discussion on IT forward in a while because of this Accenture commentary and it is likely impact on the stocks. But before that, Emami has done a very interesting move. They have actually entered the health juice category by acquiring 26% in Axiom Ayurved. Vinny is here with more on that. Vinny, good morning. Very interesting move by Emami. Axiom Ayurved, what does it do and how big is the acquisition? Entering the healthy stuff to discuss on a Friday though. But still, what are your thoughts?
Absolutely. This foray actually is important for Emami as well. Let's not forget people are moving in and shifting from carbonated drinks towards the healthcare drinks. And that is why this is a strategic decision that is made by Emami. They believe that this segment is expected to grow well going forward. And they've acquired 26% stake in Axiom Ayurveda Private Limited that has a brand called Aloe Fruit, which is mainly an aloe vera juice, a mix of an aloe vera juice. And that is what it is made from, which constitutes to around 80 to 85% of the total sales of the company Axiom. And other than that, there are some other brands as well, other beverages as well, which is included in the Axiom, which accounts to around 15 to 20%, which is like Jeevan Ras, which is herbal juice brand. So it's mainly a health drink juice brand which is there. Now, let's not forget, Axiom also has a manufacturing facility which is in Haryana, and obviously they are in a process of setting up a new plant, automated plant in Jammu as well, which is at a cost of 160 crores. So yes, that will add to furthermore to Emami as well. Let's not forget, in the past, Emami has made a lot of acquisitions as well, right? Since 2008, they acquired Janduam. Then other than that, they had Kesh King in 2015. Dermicool, which was the most recent ones in terms of March 2022, which they acquired. The performances of these brands that they've acquired have been quite mixed, because Kesh King was a bit lackluster since the time of acquisition that has come in. They've only seen a bit of a 7% growth in the last 4 to 5 years and on a CAGR basis. So that is not something exciting. So it'll be exciting how Emami actually manages to play this out, and how will it go forward from here. Yes, penetration is low in this health juice business, so that could work out well in terms of a mover advantage, first type mover advantage that they have over here, and distribution network is what Emami already has, so that could be something that they are watching out for as well. Analysts as of now are quite neutral on this stance, not much of a positive development that they're expecting, but neutral is what the rating analysts are maintaining for Emami.
Okay, thanks, Vinny, for that. Interesting one. I don't know how many takers are there. Actually, are you going to try this one?
Not at all. I have other important, interesting fruit juices, especially
Sure,
Friday
fruit
onwards.
grapes, I think, may be more preferable. What about you?
Never.
Never, huh? Nobody wants to have a health drink here,
Barley
clearly.
juice maybe, and other similar.
I can understand where you're going. It's a Friday feel, right? But the Friday feel is not going to be as much for the IT stocks. It is going to be a bit of a slam dunk kind of situation, because the street was penciling in a bit positive to come from the Accenture. Yesterday, of course, we saw a bit of a slide already, and of course the ADRs, etc. also reacted. But there are three big negatives for me which came out of Accenture earnings. One, of course, the FY24 guidance. The guidance came in at 2 to 5%. Street was working with a number of 3 to 6%. Part of the street was also expecting 4 to 7. So that's why it's a bit of a miss coming in on the guidance. The second most disappointing factor for me is the bookings. Bookings actually slipped by 10% on a year-on-year basis. Yes, the management is saying that the bookings are lumpy, and Q1 might see a bit of a bunched up booking coming in, but let's see how it pans out. And third, of course, if you look at the overall commentary, it's not very enthusing, because they are talking about how the pressure is really sustained, and for generative AI as well, the orders are trickling in, but at a very, very slow pace. But let's discuss all of this and the read-through for the Indian IT companies with Apurva Prasad from HDFC Securities. Apurva, hi, good to have you on the show. Your first take on Accenture numbers, are they really as bad as the stock reaction was with a 5% cut?
Hi, good morning. Thanks for having me, Anisha. So it is certainly muted, and what it does is it sort of talks about the risk of an extended period of softish growth. However, you should look at the guidance, in context of what's already been guided by Indian IT companies. So if you look at the deceleration of the sector from 23 to 24, which is 12-13% going to slightly below mid-single digit, that is partially what is getting reflected in Accenture's first guidance that they've given for their fiscal. Secondly, if you sort of split the consulting and the managed services piece of the business, a lot of this is to do with the decline in the consulting business of Accenture, which is half their business. And thirdly, if you look at the exit rate that the company is implying, it points to a much slower, weakish, flat start for the company and a recovery towards the end of it. That's what you make of it. But I think some of the negative read-through is coming in more specifically from verticals such as communications. And that does have some negative read-through for companies such as Tech Mahindra or a Tata Elxsi. At the same time, the bookings on the managed services side on a book-to-bill basis is pretty much similar to where it was last quarter. It was a softish quarter even last quarter. So I think what's likely to happen, and when you see IT companies reporting, the deal market share is expected to go up, and that's coming from very strong bookings that Indian IT has been doing over the past couple of months.
My follow-up question is that US economic data, which the Fed normally refers to, it always comes with a lag effect. And they are sounding very confident about the way US economy is moving. Accenture data what they're talking about future is always projected based on the US economy and what they're hearing from their clients. Historically, when US economy is contracted or recovered, it has translated into great business for Indian IT companies or for Accenture. How come this time it's different?
So Nikunj, the interesting thing about the sector is, uh, there is so much opportunity when there is cost optimization happening, and which is why I would like to refer to my earlier point. If you look at most of the deals that Indian IT has been getting, is been exactly out of that imperative that most of the enterprise are undertaking. So if you look at most of the mega deal announcements, those are to really cut costs. Having said that, the concern of the macro factors worsening is leading to some sort of a caution, which is why there is prioritization of spend. So while a lot of medium term tech outlay remains unchanged, what's happening is this caution is leading to prioritization of projects, which is why it is more of a near-term headwind. And what we are building in is a recovery in the second half of FY24. So we do expect normalization. Having said that, there are different sort of verticals which are playing out. I mean, there are divergent trends, within verticals. So if you see communications, high tech, and some parts of banking, that's playing out very differently as compared to what a healthcare or energy utilities or a manufacturing for that matter is playing out. So it's a bit more sort of vertical specific end client basis. And I think that would be one way to look at it. The other way, Nikunj, is if you look at some of the lead indicators, the classic lead indicators for the sector, which is, the tech job postings number, they still continue to be about 10-15% below where they were at the beginning of the year, although they would still be off the lows of June-July period. And that's a good indicator. So what it also means is that maybe in the next couple of quarters, the hiring momentum should start coming back. That's something which came up significantly. On the positive side, I think the good thing is that attrition is very much in control, and that's the biggest sort of cost item. And there are a lot of levers that the companies have to ensure that margins don't drop despite growth being very muted.
So net, from Q4 of last year, when there was a circuit down in many of the IT stocks here in India, Indian IT stocks, be it Infosys, that variety, the top four, or even the persistent KPIT, all of them have rallied, say, 20-25%. If Accenture does provide a pullback and unwinding of that, do you think it's a buy on decline, or you wouldn't suggest to go all out yet till clarity emerges on deal flows?
Right, Ajay. So I think so we have a selective stance out here. What I mean by that is the near-term upside on a lot of companies remain capped. But at the same time, having said that, if there is a correction, we do think, LTI, Mindtree, Persistent Systems, Birlasoft, these are some names that could outperform. And if you sort of look back the last quarter, last few months, the outperformance that the sector has been delivering has also been the multiples which sort of went higher. So it's almost between 1 and 2 standard deviation. It was sort of sub that. So it's a bit of that. It's a bit of under ownership, which was getting normalized, and there is not so much of earnings estimates that really got revised, despite this kind of an outperformance. So yeah, we do expect we continue to recommend a more selective stance in the sector, and our preferred pick is like I mentioned earlier.
So glad you could join us, Sandeep Sabarwal. Good morning.
Good morning.
You must be happy. I know you're always happy, but today you must be delighted looking at what you've been talking about IT and it's happening.
No, when the writing is on the wall, and if you don't know the language of reading it, that's the issue. So I think most people don't want to read what's on the wall. That's the issue. Not the wall which divides communities, but
coming to that wall, when are you climbing the wall? पहले वो बात करते हैं, दीवार एक ही तो है बीच में.
I went there today. There was no ladder.
See, it's all hard day today. So the more you exercise, better it is for you.
Let's move.
Okay. So IT, Sandeep, isn't this ironical that when US economy is genuinely coming back, and I'm referring to the latest update which has come from US Fed, they are talking about a big recovery in the second half for US economy. So that whole fear of soft landing, mild recession, that's over. Economy per se is coming back. If economy comes back, spending will increase, outsourcing will increase, BFS has space will expand. And historically, when US economy has expanded, it is always great news for Indian IT.
But Nikunj, see, the reality is that it's unlikely that we'll see a very sharp revival. And what also happens is that when interest rates go up so much, then it creates uncertainties in the minds of the CEOs of various companies, especially who have leverage that should we spend now or should we actually wait till the rate cycles peaked and started coming down, etc. So I think those uncertainties come up, and that leads to pushing back of investments and whatever they had planned on discretionary, etc. They just cut it down, so that doesn't come back. So I don't think the full impact of the high interest rates is reflected in the economic growth prospects yet. So the economic growth first has to come off before it revives, and to that extent, I think many of these IT companies which also have been announcing large deal wins, etc., all those deal wins are on paper. The execution has to still start, and a lot of times it just getting pushed back a lot. So, I think people are going to be disappointed in IT earnings. The forecast for the growth even for next year, unless things change very drastically, which I don't see happening. And so it's not saying that these are bad companies. So these are good companies in a bad phase of growth, and the valuations are not really cheap. These stocks have bounced back from the bottoms when the growth outlook is actually deteriorating, not improving. So I think they have to give up some of their gains again. And when they come back to their earlier lows, that could be the time to reevaluate. So that will also depend on how the overall market behaves. But that's my hypothesis at this stage as to what I am looking to do.
Now, let's revisit. Okay, just give me a second. So, Kunal, what should we talk about? Railways, defense, power, all three? None of them?
I think all three of them have been subdued right now, Nikunj. I think last 2 weeks, so that day when the mid-cap index had fallen very sharply, post that we've not seen any single day of a huge pop-up into many of these defense, power as well as the stocks. I think except for PFC, REC, the two names which spiked up a couple of days back, 5-6% odd, you've not seen majority of the power stocks doing anything quite interesting on the charts. And I think that's where the markets are getting into, because when a trend gets changed, for the stock or the index, mid-cap index in that regards, the erstwhile leaders, they tend to be initially subdued, and then they tend to mellow down the price performance, and then you see a mild correction coming into play for many of these names. So I would believe that defense names, railway stocks particularly, these stocks are bound to get into a further leg of correction.
Okay. Sandeep, while we may talk about Indian IT services companies, they are going through cyclical downturn, not a structural one. There is a very different way in which how the specialized IT companies are moving. For example, a RateGain, MapMy India. If I just throw in any of the big specialized IT companies, they are having a very strong re-rating. Now, this is a space which in a sense is new for Indian investors. Indian IT in India always meant IT outsourcing / IT services companies. But there is a new breed of companies which in a sense in last 3-4 years have taken a birth. Do you like anything from this space?
Yeah, so I think both these companies have got good business models. Now, RateGain is more on the travel side, and to that extent, whether a big part of that huge upcycle is behind us or not, we don't know. But I think they've been doing well. Then there are some catering to the defense sector also, and then the company. What was the other company you talked of?
Have we lost him there? Oh, he's back. See, Sandeep, we lost you there. Studio आगे problem ही नहीं होगा.
You said RateGain and you said another one.
No, MapMy India. I was just referring to these specialized SaaS companies as the new space where the action seems to be shifting.
Yeah, exactly. Because they are theme based and because they are moving into sectors which are potentially higher growth, they are doing much better than the other companies. So what happens in these phases is then investors find it difficult to decide what valuation should be given, and then the valuations overshoot. So I believe that these are good companies, but again, here also the valuations have overshot, and but these should be on the lookout for investment rather than the standardized IT outsourcing companies where the longer term growth prospects now could be just 5-10%.
The SGX Nifty is indicating that it could be a 3-point uptick. And Kunal, this is a big departure from what we saw, let's say, last evening, right? Last evening, Nifty was down. The GIFT Nifty till yesterday 738 was trading with about 100-point cut. But there is a very decent recovery now. Looks like the start for the Nifty, we're starting a brand new series today, is not going to be that poor.
So it may not be poor, but Nikunj, what happens is, and this is the phenomenon in the last 2-3 expiries, that there is a 100-120 point premium to the start of the fresh series, and in just a matter of I think 2 or 3 days, the premium shrinks down to 45 to 50 points. I think 50 points, maybe plus minus 5-10 points, has been the average post the first couple of days of the start of the fresh expiry. So even if assuming that the Nifty doesn't do anything and the spot remains at 19,500, 550 mark, we could be looking at the futures shrinking from 19,670, 660 where it's trading right now to another 60 points on the downside.
Sorry, point taken. Just hold that thought, Kunal. We'll come back to you. But we also have Vineet Bulinchka joining us from Ventura Securities to talk to us about MCX and how one should read through the latest headlines that we have been getting on that. Vineet, what should an investor do? It's a lot of flip-flop, and then there is this big regulatory overhang that nobody can take a call on.
So I believe that it's just a temporary suspension, and eventually it will all come through. So we will have a little bit of elevated cost for another quarter that is going on. But if you see MCX from purely a valuation point of view, today its market cap is about 1,500 odd crores, and these they were paying Moon 63 close to about 470 crores or 1/3 of its market of its net worth. So I believe that over the next couple of years, or by 26, their net worth would almost double. And if you see the valuation at what BSE quotes, it's almost 6+ times price to book. I think M6 should be valued somewhere around a little, maybe a discount to that, about 4.5 to 5 times. So this stock can easily double from the current levels, and investors should just remain put. This thing will all blow over, and things should be better off doing it.
If it falls today or reverses, would you advise a buy on that?
I would definitely put a buy on that on the downside. There is a little bit of gray area because legality is involved, and you can't really say what timeline it will take. So the safer way to play this would be to wait for the decision to come out and then go long. Maybe you might get it a little 100-200 bucks expensive.
All right, Vineet, really appreciate your time. Thank you for joining us. Now, what is the kind of rally which we've seen in MCX from the recent launch? The news that this platform will be implemented and there's going to be a cost saving of about 130 crores a quarter. 130 crores a quarter is almost like a 500 crore plus saving in a year. Last 7 days, the gain actually has been 22%. So this entire gain in the near term could get challenged. So safe to assume is not the right terminology, but it will not be hard to imagine that the gains, Kunal, of last 5-7 days can get completely wiped out.
I don't expect completely wiped out, but yes, I think it should be at least a 50% retracement. So, the stock moved from 1740 towards 2100 plus where it tested yesterday. Now, one of the most interesting data point, Nikunj, is the delivery volumes, because that determines the way in which traders have approached the stock and managed to take home position. So yesterday, for example, the delivery volume for MCX was around 7.1 lakh. This compared to the last 2 days of delivery volume was around an average of 2 lakhs, which means yesterday's impact on traders who have bought positions yesterday expecting that the stock would probably get into a free zone of a breakout and then do well. I think those traders would probably be trying to close the positions in the first maybe half an hour, first 1 hour. So I think the first 1 hour impact could be quite severe for the stock price. But I strongly believe that maybe that closer to 1980, 2000 mark, I think the prices should settle at those range broadly.
Okay, so the dips could perhaps be a bit of a buying opportunity as well, or at least there could be a bit of support. But Sandeep, I wanted your take regarding Naveen Fluorine as well, if you watch that one closely. Radhesh Welling, the managing director, has resigned, and it's been taken a lot as a negative news, given he was very instrumental in the capex as well as the expansion of the company. If you watch this one closely, a comment on that. Otherwise, any other chemical company that you like?
No, I have not been tracking this company. But broadly, my view on the entire chemical sector, like there could be few exceptions, is that the huge upswing in margins, prices, etc., everything is behind us. Today, there is more capacity, less demand. And next 2 years, we'll see further pressure on the margins of these companies, and the valuations still are much, much higher than what they were pre-COVID. So people should be really cautious. They should not look at how much they have corrected from the tops. The outlook is not great.
Also, another very interesting small cap stock, which could be in focus. Nooresh, pull up the chart of Quick Heal. It was running up almost 17% in yesterday's trade, and Blocktail data shows that Carnelian fund, Vikas Khemani, has picked up a block in the open market yesterday. Can you check the charts? Do you think it could get some more follow-up buying?
So the stock has been very erratic in terms of chart. So for the last couple of years, there would be a buyback, which is where the stock would spike and then again drift down lower or a big dividend. And now finally, over the last say roughly 2 months, the stock has seen good price volume action. From 160, the stock has gone to 275. I would expect some bit of a fade off today. The previous all-time highs for the stock are around 300, 320. So at 280 does not look like a great risk reward, but closer to 250 to 260, if a dip comes, which could be possible today, would be a good buying zone.
Well, less 10-year chart of Quick Heal. I think it's quite an old company. What do? They're making antivirus softwares. I've not used the word antivirus in a while actually. There used to be a time then you would, we would know about the antivirus.
But I think because it's become so much
Cyber.
part of the DNA now that you don't talk about it separately. It's assumed that it's there.
Already there in the hardware, but maybe there's some business model change, or maybe cyber security is a focus, right? So we will go deeper into it.
But let's look at the 10-year change. All I'm saying is the stock has done nothing in the last 8 years.
15 to 23, 8-year chart.
So it has done nothing in terms of giving a real price appreciation. But one group which has really surprised everybody, we don't talk about it, which is that South Indian group, guys.
We don't talk about it.
The Mannappa Murgappa group,
Chola
I
group.
guess. Or
Chola group.
Let's look at some of the stocks. Tube Investments, Chola Mandal, even for that matter, Kora Mandal. These are the stocks which in a sense have really, really given you numbers and returns which beat and which redefine the law of gravity. Let's look at not yesterday's chart, let's look at the 5-year, 10-year chart in some of these stocks. Whether it's Kora Mandal, Tube Investment, that entire Murgappa group per se. Kora Mandal, look at what it has done. 38 times. Tube Investment, similar kind of a number. Whoa. Hold on. 137 10 years ago has become 3,000. Then you can throw in Chola also. I distinctly remember 2014 versus now. It's just been a linear rally for this one. Sandeep, we don't talk about this group at all, right? I mean, a lot of attention goes around Kotak Mahindra Bank, HDFC Bank, PSU banks, Infosys. But this is like a pot of the gold in last 10 years. And 10 years is not once upon a time. And these are 25 to 30 time gains.
Yeah, they've done exceptionally well. Unfortunately, I have not bought any of them because they have moved up in such a straight line that they have hardly given any opportunity except what the dip which happened during the COVID sell-off. And I find it difficult to buy stocks which move up in a straight line, but they have done very well for whoever has owned them. And fundamentally, it's not that the stock price has moved up. The fundamental performance also has been very strong, and especially for Tube Investments with their when they took over the Crompton, the division. I don't remember the name now. That's also a listed company, and they turned it around. I think that's what led to the big re-rating in that stock.
So which is one corporate group, Sandeep, you would bet on? I mean, if you get let's say if you got Tata's right when Chandra took over, it's been a good success for investors. If you, let's say, got the HDFC group right a couple of years ago, it did very well for you between 2005 and 2017-18. Anything would you like to bet on as a corporate group for next 2-3 years, 5 years?
So groups is tough to define because specific companies do well. I think the Murugappa group has seen the stocks, all of them move up linearly in a similar manner. But other than that, I think in various groups, various stocks perform at different times. But I think both in terms of Tata's or even Mahindra Group, etc., they are focused companies. So I think a lot of them as a group should do well over the next few years also.
Okay, so that's the point coming in. Pharma, that seems to be coming back into focus as well. Sandeep, what are your recommendations there?
In pharma, we own Sun Pharma, which has been doing well steadily. So no big swings here or there. And Lupin, we picked up 1.5 odd years back as a potential turnaround candidate. So it didn't do anything for 1 year, but then after that, the re-rating cycle is playing out and fundamentals also seem to have turned. That's still 50% off its all-time peak. So that could still have potential if the earnings growth and the turnaround plays out the way the management is indicating, and that's something we need to monitor. The smaller pharma companies, I typically tend not to buy.
What's about the manufacturing names? Anything specifically in the healthcare vertical, and I'm talking about diagnostics or hospitals, because we have been seeing how the spend overall has been going higher. Any name that you like from that, or the valuations are punchy?
The diagnostics has become very competitive. Growth rates are just 5 to 7%. So I don't think there's any big story out there. Stocks are still expensive, so they got sold out so much that some of them are getting some bounces. Some analysts are saying there's some price uptake. I don't see that's happening. Hospitals overall as a space is a good space, but again, the valuations of the hospitals which have done well, Rainbows, Narayana, Apollo Hospital, etc., are not exactly cheap, but this is a segment which people should have a look out if the correction happens.
This Chola QIP is heard to be getting very good response, 40% kind of growth. This appears to be a trend now. All these high growth NBFCs are raising growth capital once again. Any name you like there?
So I think what happens in all these financial companies is that when there is money at a higher book value than on price to book, they start looking cheaper. That's what happened with Bajaj Finance, and it rallied, and Chola is doing the same thing. So I think many of these companies are just taking the opportunity of the very high price to book they are getting to raise capital, which is a good thing from the perspective of the management. I would still be like, I'm not buying at these levels. But but historically, we've seen that when price raise happens at a high price, these stocks typically do well after that.
Okay, so that's the point as far as Chola is concerned. The pre-open rates are just kind of trickling in, and for now, it looks like we are going to start in the green, not by a whole lot, but at least the Nifty is showing that we might be around 19,600. Let's give it time for the rates to settle, because this seems a bit over enthusiastic. It'll be great if we do open around 19,600, but let's just wait for those rates to settle as well. In the meantime, let's take the index as well as the mid-cap calls from our chartist. Nooresh, what's the mid-cap strategy that you're picking up?
So that would be a buy on Oil India. The stock has given a breakout yesterday, pulled back a little, but was one of the largest volumes seen on the stock for the last 6 months. The previous high on a non-dividend adjusted basis is closer to 305. This is we topped out where we topped out in June 22. Finally, the stock has come back. Good price volume action, a huge cup and handle formation, enough consolidation done between 270 to 300. Expecting a target price of closer to 350, stop loss at 285.
So that's about Oil India. It's a buy recommendation, Kunal.
I'll go with the contraband Dream Folks. That's a stock which has managed to get into an oversold territory. In fact, the RSI has already given a swing breakout on the weekly chart. So I'm expecting that the prices would also move in a similar manner on the upside. 525 is the target, stop loss at 480.
Okay, so those are the top recommendations coming in from our charters. But let's get you the news that's happening across the globe as well. A gunman went on a shooting rampage at a house and a hospital in Rotterdam, killing a 14-year-old girl, her mother and a teacher. Dutch police said that they were still investigating the motive for the twin attacks by the 32-year-old man who also set fire to the hospital and the house. Meantime, External Affairs Minister S. Jaishankar met their US counterpart Anthony Blinken in Washington and discussed a full range of issues, but there was no mention of the row with Canada's allegation that India was involved in a killing of a Khalistani terrorist. Kaveri water war escalates as pro-Canada organizations are protesting today against releasing water to Tamil Nadu. All schools and colleges will be shut, but metro, bus services, banks and government office will continue to operate. Kaveri panel, remember, will hold the meeting later today. Shifting gears to earnings now, Nike reported its Q1 earnings beating the street estimates. Stock rallied almost 9% in overnight trade. During the earnings call, executives stressed on the strength rooting from the customer demand right now. And from the world of sports, India's shooting stars continue their medal run. The Indian contingent clinched the gold in the men's 50-meter air rifle 3P team event, while women's 10-meter air pistol team won the silver at the Asian Games. Meanwhile, hopes are high now for both the gold and the silver medals from the badminton team, which is in action currently.